on the debit side. Expense accounts, remember, same way as drawing, they're negative on the right. I had to take it over to the left so they look exactly the same way assets do. They increase on the left or debit side, they decrease on the right or credit side. All right, so let's look at some examples, and I think this will be seen a little bit more clearly. Okay, this is a transaction. We got to identify the accounts and what happened to them. Purchased office supplies for $800 cash. Okay, so I have two things that have to happen, or two things that were affected. First of all, office supplies. I'm buying office supplies. I'm not using them up, I'm just purchasing them. So I'm going to increase it, so it's an asset. I'm going to increase office supplies by $800. And what am I using to pay for that? I'm using cash. So I'm going to decrease my asset cash for $800. Okay, so let's look at, those are my two. Now, they're both assets. So what's going to happen? Cash is decreased, right? So that means the entry to cash is going to go on the right side or the credit side. And the entry to accounts payable, I'm not accounts payable, excuse me, office supplies, which is also an asset, it's an increase, so it's going to go on the left side. So as I write these down, identify the accounts, then you start putting in the numbers in. Okay, so I write cash down. They're both asset accounts, so the plus minus is going to be the same. So then we say what happened to each one. Well, we said office supplies increased, so we put the 800 there. That's my debit entry. And office supplies, that's the only thing that happened to office supplies. Okay, did cash increase or decrease? Well, we paid cash, so it decreased $800. So what? It was a credit entry. So I have a debit of 800 and a credit of cash of 800. So my debits and credits are in balance. I have 800 debits, 800 credits. Transaction is complete. Okay, let's go through another one. Purchased equipment on account for $3,000. Okay, so let's break this one down again. Purchased equipment. Equipment's going to last us. We're not expensing something for a month. If I buy a piece of equipment, I'm expecting it to last for more than 1 year. So it's going to get classified as an asset. Did we pay cash for it? Normally, if it just said purchased equipment for $3,000, that's what we would assume. But they said purchased equipment on account for $3,000. So anytime I see on account, if it's related to a sales transaction, it means, or a customer, it means accounts receivable. If it's related to accounts payable or a purchasing transaction, which I'm purchasing something, then it's related to accounts payable. So so I got $3,000 liability accounts payable, and I'm going to be increasing the amount that I owe. I didn't spend any money right here, so I'm going to owe $3,000. So the liability accounts payable is going up $3,000. Equipment is an asset, and it's going up $3,000. Okay, so there's the accounts that we chose: equipment and accounts payable, an asset and a liability. Now let's put them into the accounts. Okay, one's on the left side of the equation, the other one's on the right side. But I've got assets over here. The equipment did what? It increased. So there's my debit. What happened to accounts payable, which is a liability? Boom, it goes on the credit side because it increased. All right. Equipment increased, so the debit entry goes there. Accounts payable decreased or increased as well. But remember, it's a liability, so it's not handled the same way as an asset. Where's the plus side on liability? It's on the right hand side. So until you get used to doing this, what I recommend you do is whenever if you just see DR and CR, you write for whatever type of account it is, you put underneath it minus and plus, just so, or plus and minus, whichever one it happens to be, because it will help you to remember those rules every time you look at it. And if you get ready to take a quiz or a test, well, then you write down the accounts that we've used in the chapters, and just have your little page and plus minus, debit and credit. Use it as a study sheet, crib sheet, whatever you need to do. Okay, so debits are equal to credits on this transaction. A 3,000 debit to equipment, a 3,000 credit to accounts payable. Now, what does that mean again? A 3,000 debit just simply means one account got a entry put on the left side, another account got an entry put on the right side for this, and the left side entries and the right side entries do what? They equal each other. Okay, another example. As we're going through this, this one is Doc D. Williams, the owner, invested $25,000 in the business. Okay, so let's think back. The owner puts money in. Well, let's go over to this note page here. Assets plus expenses plus drawing is equal to liabilities plus revenue plus capital. Okay, which account does owner investment fall under? Doesn't fall under revenue, we didn't earn it. Doesn't fall under drawing, he didn't take it out. It doesn't fall under expense because we didn't pay anything. Okay, so this is money coming in, it had to go to capital. That's an owner's equity account. That's an increase when owners put money in. Okay, so capital's involved. And what did he put in? There's no other notation said what denomination it was in, so we have to assume that $25,000 is in cash. So I have cash and capital. So there's my two accounts. Owner's equity is D. Williams Capital. The asset cash is also affected. All right. So looking here, what happens to cash falls under the asset category. Owner's equity, Damon Williams Capital falls under that. Okay, so we put our identifiers in there, plus minus. Capital gets a plus on the right or the credit side, and a minus on the debit side or left side. Cash gets a plus on the left side and a minus on the right side. Okay, now what happened? $25,000 cash came in from D. Williams Capital. So D. Williams ownership in the company is going to go up $25,000 because of the amount that he put in. All right, so $25,000 is going to be an increase. It's going to go on the credit side, and cash is going to be debit, so $25,000 here because it's increasing as well. Okay, my transaction now has a $25,000 credit and a $25,000 debit to different accounts. Is it in balance? Yes. The debits and credits equal. And so transaction is complete. Now, Damon Williams, I guess that was the name of the last one. Damon Williams withdrew $1,500 for personal expenses. Now the key word there is personal expenses. I'm sorry, I must have hit the arrow key on the mouse. Went a little bit too far. $1,500 for personal expenses means withdrew and personal, it goes to the drawing account. The owner is taking money out of the company. All right. It doesn't say withdrew 1,500 of what, like equipment or anything like that. So we have to assume Damon is taking out cash. So cash is my asset. That's getting. I'm going to take away cash, and Damon. The drawing account is where the $1,500 is going to go. All right. So once I have that, let's go back out here to the note sheet here. Drawing It's positive on the left, it's negative on the right, according to these equations. Assets, positive on the left, negative on the right. So what's happening? Cash, positive on the left, negative on the right. Damon Williams, positive on the left, negative on the right. So the drawing account is increasing by $1,500. The cash account is decreasing by $1,500 because they withdrew it. So I have a debit entry to drawing and a credit entry to cash. And my 1,500 debit is equal to my 1,500 credit. Remember, every transaction has at least two pieces. Okay, Damon, who's the owner again, performed services and received cash, $4,500 in cash. Anytime I perform services, that is earning revenue. So revenue is my account, and I'm going to receive one of two types of assets. Accounts receivable, which is a promise to pay me later from a customer, or I'm going to receive cash. In this case, it's cash. So we have cash, which is the asset that we're receiving. The revenue account that we earned, and they're calling it consulting fees. Okay, so go back out here. We've got assets and revenue. Assets is on the left, so plus on the left, minus on the right. Revenue is what? Plus on the right. Take it on the other side, it's minus. So plus on the right and minus on the left. Okay, so we would add those in there. Consulting fees, plus on the right, minus on the left. Cash, plus on the left, minus on the right. Alright, so what happened? Revenues increased because they performed service. We earned revenue. So revenue, which is in this case consulting fees, increased by $4,500. I also received $4,500 cash, which means my cash goes up by $4,500. So the consulting fees revenue going up is a credit on the right side, $4,500, and the increase in cash that I receive is a debit on the left side for $4,500. And I am in balance. I've got 4,500 debit and 4,500, so the transaction is good. I'm ready to move forward. Damon, in this case, performs $6,000 of services on account. Now, we just talked about this. Performing services is going to be revenue related. So I know the $6,000 is going to go to the consulting fees revenue account. Now, I said you get one of two assets. It's either accounts receivable or cash when you perform services. If they don't pay you cash, then it goes into accounts receivable, and it does say on account here. So that means that the money that's owed to you goes into accounts receivable. So consulting fees and accounts receivable. Accounts receivable is doing what? It's increasing, right? The amount that's owed to you from a customer goes up by $6,000. Well, accounts receivable is an asset. If we look at we've got assets and revenue, so we know consulting fees was already over here, plus on the right, minus on the left, and then my assets are plus on the left and minus on the right. So the increase in accounts receivable, the increase in consulting fees revenue,